What if everything you've been told about money is a distraction? What if the real engine of the global economy isn't innovation, or trade, or even stocks, but something darker, more complex, and utterly inescapable? We're told debt is a TULA mortgage for a home, a loan for a business, a bond for a government. Manageable. But what if that debt has mutated? What if it has woven itself into a web so vast and so interconnected that it now controls the very system it was meant to serve? This isn't a story about a single villain or a shadowy cabal. It's about a systema financial ecosystem that evolved in the shadows of post-war prosperity. An ecosystem where debt stopped being a simple IOU and became a living, breathing, and highly contagious entity. It's a web that has ensnared nations, toppled empires of money, and forced central banks into a desperate perpetual rescue mission. And we are all caught in it. Today, we trace the origins of this hidden web. We'll see its quiet birth in the 1970s, its explosive growth in the age of deregulation, and its devastating coming vage in 2008. We'll follow the thread to today, where the web is larger, more complex, and more dangerous than ever. And by the end, you'll understand the three undeniable forces that now govern your financial reality. This is the story of the synthetic economy, the story of the derivative. Our story begins not on a trading floor, but at a resort in New Hampshire. 1944. Bretton Woods, the Allies, winning World War II, designed the financial architecture for the peace. The rule is simple: the US dollar is king, but it is a king in chains. It is convertible to gold at $35 an ounce. Every other currency pegs to the dollar. This is stability, enforced by America's economic and military might. For decades, it works. The world rebuilds. But there's a flaw. To fuel global growth, the world needs more dollars. America provides them running trade deficits, sending dollars overseas. But the gold in Fort Knox doesn't grow. By the late 1960s, there are far more dollars in foreign hands than there is gold to back them. The system is a promise that cannot be kept. Then comes August 15, 1971. President Richard Nixon, facing inflation and a run on U.S. gold, makes a historic announcement. He temporarily suspends the dollar's convertibility into gold. The temporary suspension becomes permanent. The king is unchained. This is our first cause. The dollar, and by extension all global money, is now fiat. Its value is based purely on faith and government decree. It is no longer anchored to a physical object. This creates a terrifying and liberating question. What is money really worth? The answer? Whatever the market says it is. And the market is volatile. Cue the 1970s oil shocks. Prices skyrocket. Inflation runs wild. This volatility is a problem for every corporation doing business across borders. If you're an airline, how do you budget for fuel next year when its price in dollars can double? If you're a German exporter, how do you price goods for America when the dollar-mark exchange rate swings violently? The financial system needed a shock absorber, and Wall Street was about to provide one not by reducing risk, but by slicing it up and selling it. Enter the derivative. At its core, a derivative is a financial contract whose value is derived from the performance of an underlying asset, a currency, an interest rate, a stock index, a bundle of mortgages. It's a bet on the future price of something. The oldest forms, like futures for crops, have existed for centuries. But in the new, volatile fiat world of the 1970s and 80s, they evolve. The first key innovation is the interest rate swap, pioneered by banks like Salomon Brothers. Imagine two companies. One has a loan with a fixed interest rate, but wants a variable one. The other has the opposite problem. Instead of taking out new loans, they enter a private contractor swapware. They agree to exchange interest payments. They haven't borrowed new money. They've created a new financial relationship, a new strand in the web. This contract exists only on their balance sheets and in the trust between them. Then comes the mathematician. In 1973, Fisher Black, Myron Scholes, and Robert Merton publish a formula that claims to price the risk of options with mathematical precision. The Black-Scholes model gives the illusion of taming uncertainty. It turns risk from a frightening unknown into a calculable, tradable commodity. For this, Scholes and Merton would win the Nobel Prize. Their model becomes the Bible. Deregulation in the 1980s and 90s, Hendra Thatcher, and eventually Clinton tears down the walls between commercial and investment banking, and refuses to regulate derivatives. The mantra: sophisticated players can manage their own risks. The web is allowed to grow in the dark. And grow it does. From simple hedges, derivatives morph into tools of pure speculation. Why buy an actual barrel of oil when you can buy a contract betting on its price? Why hold 1,000,000 mortgages when you can bundle them, slice the bundle into tiers of risk, and sell derivatives on those tranches? This is the birth of the collateralized debt obligation, the CDO. It's debt layered upon debt upon debt. By the early 2000s, the notional value of the global derivatives market, the theoretical value of all the underlying assets these contracts reference, soars into the hundreds of trillions of dollars, a number far larger than the entire world's economic output. The web is now the largest financial market on Earth, and it exists almost entirely in the shadows between the balance sheets of the world's biggest banks. It is the market that controls all other markets. The system needs fuel, constant, predictable fuel, and in the 2000s, it finds it: the American homeowner. With interest rates low, after the dot-com crash, a housing boom begins. The demand for mortgages is insatiable. But there's a problem. You eventually run out of credit-worthy borrowers. Solution: lend to the non-credit-worthy, the subprime borrower. But why would a bank take such a risk? Because of the web. Here's the cause and effect chain, the web in action. A mortgage broker issues a risky loan to a borrower with poor credit. The originating bank immediately sells that mortgage to a giant investment bank. That bank pools thousands of these risky mortgages into a CDOA bond backed by mortgage payments. Using mathematical models, they slice the CDO into tranches, senior tranches rated AAA, mezzanine, and equity. These tranches are sold globally to pension funds, municipalities in Norway, banks in Germany, and hedge funds everywhere, all hungry for yield. But it doesn't stop there. They then create derivatives on the CDO tranches credit default swaps, or CDOs. These are insurance policies against the CDO failing. You can buy a CDS even if you don't own the CDO. It's a pure bet on failure. The original risky mortgage has now been replicated 1,000 times, woven into a global web of interconnected obligations. The risk hasn't disappeared. It has been obscured, magnified, and spread to every corner of the globe. The system is so confident in its models that a firm like AIG sells hundreds of billions in CDS protection, believing the AAA tranches could never fail. They collect premiums like free money. The breaking point is simple physics. When housing prices stop rising, subprime borrowers start to default. The first strand snaps, but in a web, one snapping strand pulls on all the others. The AAA tranches, packed with now toxic mortgages, are downgraded. The CDS insurance policies that AIG sold are triggered, demanding colossal payouts it cannot make. The trust that forms the foundation of the shadow banking system, the trust that these contracts will be honored, evaporates overnight. September 15, 2008, Lehman Brothers falls. It isn't just a bank failing, it is a black hole in the center of the web. No one knows who is exposed to whom. Trillions in derivative contracts are suddenly in limbo. Lending between institutions freezes. The global economy, which runs on short-term credit, has a heart attack. The hidden web is suddenly horrifyingly visible. The fallout is panic. The failed fix is the belief that the system itself could be saved without addressing the web. The immediate rescue: the TARP bailouts, the Fed guaranteeing everything was necessary to prevent a total collapse. But the long-term fix was a Faustian bargain. Instead of untangling the web, the authorities sprayed it with financial adrenaline and reinforced it with public money. The cause: save the system at all costs. The effect: moral hazard cemented. The banks knew they were too big to fail. The web was too interconnected to fail. But the deeper effect was on the very nature of money. Central banks, led by the Federal Reserve, embarked on quantitative easing, or QE. They created new digital money out of thin air and used it to buy trillions in government bonds and toxic mortgage assets from the banks. The goal: lower interest rates across the board and reinflate asset prices. It worked, but with catastrophic side effects. It created the everything bubble. Cheap money didn't just go into rebuilding businesses. It flooded into stocks, real estate, and speculative assets, widening the wealth gap to historic levels. Zombification. It allowed zombie companies and profitable but kept alive by cheap debt to persist, clogging the economic arteries. The central bank the market internalized a new rule. If asset prices fall too much, the Fed will step in. This removed natural risk from the system, encouraging even more reckless behavior within the web. Most crucially, the derivatives web survived and grew. Post-2008 reforms focused on making banks hold more capital against their traditional loans, but the dense over-the-counter derivatives market was only slightly nudged toward more transparency. Its notional value today, over $600 trillion, it is still the dark matter of the financial universe. This isn't history. This is the operating system of your present. The patterns are repeating in new, bizarre forms. Parallel 1, the Everything Bubble 2.0. The pandemic crash of March 2020 saw the web seize up again. The response? Even bigger, faster bailouts. The Fed's balance sheet ballooned from $4 trillion to nearly $9 trillion in 2 years. The result? A faster, more insane bubble in everything from tech stocks to cryptocurrencies to NFTs. It was 2008's playbook on steroids. Parallel to the rise of the shadow banking. Regulated banks are now surrounded by a vast ecosystem of non-bank lenders, hedge funds, private equity, venture capital, and complex ETF structures. This is where the risk has migrated. Look at the Archegos capital meltdown in 2021. One family office, using total return swaps, built a hidden $30 billion position in stocks. When it collapsed, it lost $20 billion in days and vaporized prime brokers. The web is now populated by opaque, unregulated entities playing with the same dangerous tools. Parallel 3, the weaponization of the web. Derivatives are now central to political and economic warfare. Sanctions on Russia targeted its central bank's access to the global payments web. The weapon is exclusion from the system. Conversely, countries are now exploring central bank digital currencies, CBDCs, which could create the ultimate tool for surveillance and control within the financial web. The shocking data point, global debt governments, corporations, households, has reached over $300 trillion, nearly 350% of global GDP. We have spent 15 years solving a debt crisis with more debt, papered over by a web of derivatives and central bank money creation. The system is more leveraged, more interconnected, and more reliant on the perpetual trust that the authorities can control it all. So, what does this mean for you? The web isn't an abstraction. It governs the price of your home, your retirement portfolio, the stability of your job, and the value of your currency. From this story, 3 clear takeaways emerge. 1. Stability is an illusion managed by constant intervention. The free market in finance died in 1971. What we have today is a centrally managed volatility system. The Fed and other central banks are now permanent market participants, using their balance sheets as shock absorbers for the web. The calm isn't natural. It's engineered at the cost of greater long-term fragility and inequality. 2. Complexity is the enemy of resilience. The derivatives web was built on the lie that complexity, via mathematical models, could disperse and destroy risk. In reality, complexity hid risk, correlated it, and made the entire system impossible to understand or manage. When it broke, no one could even find all the broken pieces. Our modern system, with its crypto DeFi, algorithmic trading, and shadow banking, is orders of magnitude more complex. 3. The real economy is now a subsidiary of the financial system. Productivity, wages, and innovation no longer drive the financial markets. Instead, financial market movements, driven by central bank policy and flows within the web, dictate the fortunes of the real economy. Companies are rewarded for financial engineering over actual engineering. We are living inside the derivative. This leaves us with an unsolvable problem. A financial catch-22. If the authorities try to normalize raise rates, shrink their balance sheets, let failing entities die, they risk snapping a critical strand in the web, triggering a chain reaction collapse worse than 2008. If they continue to backstop everything, they fuel more moral hazard, more asset bubbles, more zombie firms, and the gradual devaluation of currency through inflation, slowly starving the productive economy. There is no clean exit. The web must be perpetually fed with liquidity, or it will consume itself. We are in a financial experiment with no known end state. Your greatest defense is understanding. Don't get lost in the day-to-day drama of market headlines. Look for the deeper patterns, the actions of central banks, the growth of debt, the eruptions in the shadow system. Educate yourself on monetary history. Be skeptical of financial alchemy that promises high returns with low risk. That is the siren song that built the web. Diversify not just across stocks, but across realms. Hold some real assets outside the purely digital financial system if you can. This isn't about predicting a crash, it's about recognizing the terrain. You are not just an investor, a worker, or a consumer. You are a participant in a vast, unstable, and breathtakingly complex human experiment. The web controls the global economy. The only question that remains is who or what will eventually control the web? What happens when the next stress fracture appears? What strand will snap first? The answer is hiding in the shadows of the system right now. And that is a story for next time.